Bookkeeping can be challenging. From recording each income and expense of your business to reconciling your accounts at the end of each month, bookkeeping often requires attention to detail. And even a single wrong entry can lead to multiple discrepancies, making your bookkeeping more complicated than it already is. I am Nora with SAS Ant, an accounting automation platform, and I am here to tell you about the basics of bookkeeping. We know of these challenges firsthand because at SAS Ant we help hundreds of business owners, bookkeepers, and CPAs each month to get their accounting in check. So if you're a business that deals with tens to hundreds of transactions each day, then this video will help you manage your books perfectly. Bookkeeping is a critical part of the accounting lifecycle. In fact, it's like the guardian angel of your company's financial records. It requires tracking each financial transaction that enters and leaves your business and recording it in an orderly fashion. Bookkeeping allows you to record income and expenses, do accurate tax calculation, analyze transaction data, measure business performance. Quite simple, right? Well, not really. Though it looks quite easy at a high level, maintaining books and recording transactions is a day-to-day job and requires careful maintenance. And depending on the size of your business, you may have to choose either a single entry or double entry system. Single entry and double entry bookkeeping are the two main types of bookkeeping your business can choose. But what is the difference? In single entry bookkeeping, you record each transaction as a single entry in your cash book. Okay, so what's a cash book? It is a journal that organizes transaction details by date, description, and if a transaction is an income or an expense. The income account records the revenue made by a company. An expense account records business expenses. For example, if you buy a new laptop for your business for $1,000, then it's recorded as an expense and is debited from your account. Now, if you receive a payment of $500 for an invoice, then it is recorded as an income and is credited to your account. Small businesses with a limited number of transactions use this method of bookkeeping as it's easier to maintain. Now, let's look at double entry bookkeeping. Double entry bookkeeping is standard across the accounting industry. Almost all it requires that each transaction is recorded in two different accounts. The thumb rule in it is that the total credits and total debits of a transaction have to be balanced. But why double entry? The double entry system helps accountants reduce mistakes. It also helps by providing a good check and balance benefit. It gives complete information about a transaction when compared to the single entry method, as each transaction consists of both a destination and a source. A debit indicates an asset has been purchased or an expense has been incurred. A credit indicates revenue has been brought into a business or liability has been paid off by another party. Still confused? Let me put it this way. Debit is an increase in assets or expenses and a decrease in liabilities or owner's equity and revenue. Credit is a decrease in assets or expenses and an increase in liabilities or owner's equity and revenue. For example, if a company buys new office furniture with cash, they would debit the furniture asset account and credit their cash account. This means that they bought something tangible with money that they already had on hand. Thus, their cash account balance decreases, which is a credit, and their furniture asset account increases, which is a debit. Here's another example. If a company sells services to another business for $1,000, then they would credit their sales account for $1,000 while debiting the customer's accounts receivable for the same amount. This means that the company gained money through selling services, thus increasing their sales account balance, which is a credit, while simultaneously increasing the customer's debt, which is a debit. Here is a list of rules of debit and credit. Debits and credits are very important to the double entry system. Debit refers to an entry on the left side of the accounting ledger, and credit is defined as an entry that is recorded on the right side of the account. Bookkeeping requires you to enter transactions into the general journal. A journal is a detailed account that records all the financial transactions, debits and credits of a business to be used for the future reconciling of accounts and the transfer of information to other official accounting records, such as the general ledger. It is a book of raw business transactions recorded in chronological order by date. What a bookkeeper needs to do is reorganize all the journal entries and group like items together. To do this, you would need the chart of accounts. A chart of accounts is a list of all your company's accounts together in one place. It provides you with a bird's eye view of every area of your business that spends or makes money. The main account types include revenue, expenses, assets, liabilities, and equity. Asset accounts record any resources your company owns that provide value to your company. They can be physical assets like land, equipment, and cash, or intangible things like patents, trademarks, and software. Liability accounts are a record of all the debts your company owes. Liability accounts usually have the word payable in their name. Accounts payable, wages payable, invoices payable. Unearned revenues are another kind of liability account, usually cash payments that your company has received before services are delivered. Equity accounts are a little more abstract. They represent what's left of the business after you subtract all your company's liabilities from its assets. They basically measure how valuable the company is to its owner or shareholders. Revenue accounts keep track of any income your business brings in from the sale of goods, services, or rent. Expense accounts are all of the money and resources you spend in the process of generating revenues, that is, utilities, wages, and rent. Before you can record transactions, you need to create a chart of accounts for accurate bookkeeping. You can download our bookkeeping template from the description below, which also has the chart of accounts. Once you have completed entering transactions, it's time to reconcile your accounts with your bank statement. This involves closely examining your bank statement and your bookkeeping data to identify any potential discrepancies or irregularities. This could include reviewing customer payments, vendor invoices, cash receipts, checks written, and any other financial transactions. Additionally, any changes in account balances need to be reviewed to ensure accuracy. At the end of your reconciliation, you have to ensure that all debits and credits are balanced and the difference should be zero. If there are any discrepancies, you need to make necessary corrections or entries to maintain the balance. Furthermore, reconciling bank statements will aid businesses in detecting any suspicious activity or fraudulent activity that may have gone undetected otherwise. It is important to thoroughly analyze all business accounts, checking accounts, credit card accounts, and bank accounts. You can find a bookkeeping template which can help simplify this process easily. You can also use SAS Ant to improve and automate your bookkeeping tasks. SAS Ant works perfectly with well-known accounting software such as QuickBooks and Xero. It helps automate your journal entries with bulk import and export of transactions and syncing your transactions from e-commerce platforms. With over 3,000 plus 5-star reviews and various CPA vouching for us, you can rest assured that your bookkeeping gets much easier with SAS Ant. So that's the end of this bookkeeping video. What are your thoughts? Did this video help you? If so, share your comments with us below. Till we meet next time, have a nice day.